From New York City for our viewers worldwide, I'm Sonali, Basak, and Bloomberg Real Yield starts right now. And coming up, President Trump visits the Fed, but signals that Powell's job is safe, at least for now. And Trump's visit coming just days before the Fed makes its rate decision next week. And over in credit, we're watching leveraged loan volumes red hot, yet Goldman downgrades their recommendation for bank bonds. But we begin with the big issue: when should the Fed cut rates?
Jay Powell shouldn't cut rates today.
I'm not pushing for rate cuts.
They've kind of set it up for September.
If the Fed doesn't cut at the September meeting, I think the president moves forward with a shadow chair nominee announcement. What the president really wants is for the Fed chair to resign.
This is all just a bunch of game playing.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there.
We see this fixed income regime as one where there isn't a big interest rate bet to make. So I think the bond market has found an equilibrium.
When you start to look at where the market is pricing, they're asking about, they're pricing cuts, but they're also pricing higher inflation.
The easier path is always one that leads to potentially more inflation down the road.
Underlying inflation, I think, is stuck at around 2.5%, not close to 2%. That's ex of tariffs. At what point do we stop saying this is a transitory shock? When does transitory stop being transitory?
There's a temptation to think, well, maybe tariffs don't matter. And then as you get deeper into the second half of the year, that's when our economists at Morgan Stanley are forecasting growth to continue to decelerate, get a little bit of rockiness, not severe rockiness, but a bit of rockiness in the third quarter.
Now, I want to start by looking at how bond traders have been boosting their bets that the Fed will cut rates more aggressively this year, but particularly next year. This is the yield spread between futures maturing in December of 2025 and December of 2026. And it reflects expectations of how deeply the Fed will cut rates in that period. Now, investors are now pricing in around 70 basis points of cuts next year compared to just 25 basis points priced in as recently as April. Remember, the president himself wants 3 percentage points lower. Traders are starting to at least put on a trade that you'll get some of that. Let's flip up the board here and look at the 530 curve, because even though traders are betting that the short end of the curve will come down, there are doubts about the longer end. Investors, including Deutsche Bank, double line as well, believing that the yield curve will steepen. They say it's the clearest hedge against risks to the Fed's independence because that long end might just take off. Now, I mentioned Trump's trip yesterday to the Federal Reserve. Here's a little about what he had to say about rates and about Fed Chair Powell.
Well, I'd love him to lower interest rates, but other than that, what can I tell you? We had a little talk about it, and I thought it was a very productive talk. He'll be able to tell you at his next meeting, but I will say that he did say the country's doing really well. His term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, the higher rates, they're all on board. They all want to see the interest rates come down. It's very important.
We're going to talk to a couple people who know a little about the right thing to do. We're going to bring in Stephanie Roth, chief economist at Wolfe Research, and David Rogal, lead portfolio manager of BlackRock's Total Return Fund. And there's money at play here, right? When you look at the economic data, Stephanie, do you think that the Fed should cut at least once this year, if not twice?
I think that they're not going to end up cutting at all this year. I think we're in an environment where the economy is going to be okay and inflation is going to be sitting here elevated, running above 3%, which is not a great environment for the Fed to be cutting. So I think we're actually going to be sitting here with 2 cuts in 2026, but none for the rest of this year.
How do you feel, David? Do you think that you can make a trade based on what the president wants at this point? Is that what that chart was showing? Or is it reflecting the reality of how many cuts can really be achieved through the end of next year?
I think there's a lot of speculation, particularly in that 2026 calendar on the next Fed chair and what happens there. But I think actually I have a slightly different perspective. I think the case for maintenance cuts has actually improved in the last few months. If you look at the last 4 to 5 months of inflation readings, we're running really less than 2% inflation. We've not had much pass through from tariffs. We've had a step down in services inflation. And I think the one thing really keeping the Fed from moving is the prospect of tariff-driven inflation. And we may see that pick up a little bit in the next few months. But when we think about the impact of tariffs, we view that more as a consumption tax. We view it more as a transitory effect. It's much different than the COVID-style inflation that we saw. We saw $5 trillion of helicopter money during the COVID era stimulus that drove demand-side inflation. So we think this is a very different environment.
We pushed Steven Myron on this pretty hard. Why? What's the case for a cut this year when the economy is still strong? Financial conditions are still quite loose. I love this show, by the way. Spread makes a market. Stephanie, why do you think that the Fed can't really cut this year? Do you think that inflation could be more sticky than meets the eye?
Yeah, I mean, so the weakness that we've seen in services and inflation will probably go the other way. A lot of that was travel related. It was about a 25 basis point headwind on CPI, 10 basis point headwind on core PCE. That's literally going to go the other way in the next couple of months. And you started to hear the CEOs from airlines comment that they're starting to see demand pick up. I think that was a combination of softer travel demand, partially because of concerns around the tariffs and the economy is now proving to be kind of okay, and all of the accidents that played out earlier this year, and now you're starting to see the travel side start to go the other way, in which case you're going to start to see tariffs hit the data as well as the travel stuff, and then you're going to start to see inflation pick up. At the same time, if we see the unemployment rate remain roughly where it is, 4.1, 4.2, it's going to be a tough environment for the Fed to be cutting in September.
You look at the market, and at least on the equity side, you see a lot of exuberance. Crypto stocks just taking off. You see SPACs listing Bitcoin treasury companies. I guess, why do you think that a rate cut here, David, won't set off more animal spirits in a way that starts to set this market into a place that's not healthy?
Yeah, it's a very fair concern. I think the economy actually is not that sensitive to the short-term interest rate. What we saw in the last decade really was an economy that became less sensitive through terming out of debt, through the long tail of QE. And what we're seeing now is that the interest rate is really impacting certain segments of the economy. Auto loans, the real estate market, parts of that market are looking on the weaker side. So I think it's really more about taking out a bit of an insurance policy. I actually think the Fed could cut next week. It's not been telegraphed. If I were the Fed, I would cut a quarter point next week. I would wait and see how inflation evolves over the next few months. If it turns out that inflation's reasonably subdued, they can keep going. If it turns out that we see a bigger tariff shock from inflation, they can stop. And the market is pricing almost 50 basis points of cuts this year. If they went next week and stopped, that would still be a hawkish outcome relative to the market.
We will get back to that. But, setting up for next week, the big Fed meeting, Stephanie, how are you setting expectations for clients right now?
I don't think it will be that eventful of a meeting. I think Powell's just going to continue to reiterate we're watching the data. Certainly, whether or not they should be cutting in July, I certainly don't think they will be. Governor Waller is one of the few that are really outspoken about that. So realistically, we'll see a meeting where it's very much wait and see. It's very, very data dependent. And then it'll be setting up for optionality for September. So they're going to certainly leave the door open, keep the market, pricing in the way it is. There's no reason for them to deliver a hawkish outcome this week. So my expectation is they're going to come in and just say, we're watching the data. We'll see inflation as it evolves. We're keeping an eye on the labor market.
I'm going to follow in with you on this because there's a view out there that if you do see the Fed start cutting earlier, or if you see folks like Waller start to dissent, right, that this is to appease the president at this point in time. With the Fed's credibility under question in a lot of ways right now, with the president putting so much pressure on the Fed, how do you view that issue of central bank independence?
Yeah, I mean, central bank independence is critical. So to the extent that he would, succumb to any of the pressure, certainly don't expect that will be the case. If anything, maybe you could argue the opposite. They have to preserve that independence such that maybe they'd be hawkish on the margin. That said, I think they're going to do what they think is right, and Powell has proven to be very, very much data dependent, independent from all of this rhetoric, and he's going to do what he thinks is right. And if the September meeting, if the data line up for them to be able to cut, call the unemployment rate rising towards 4.5%, then sure, they're absolutely going to do it. But if we're sitting here heading into the September meeting, and core inflation picks up to about 3% annualized over the summer, and the unemployment rate is sitting around 4.2, even 4.3, I think it's going to be a tougher argument for the Fed to be cutting.
Okay, so what does this mean in terms of how you're trading this, David? Because if you have so many people betting on steepeners, you have seen a material steepening already. Would you go further into that trade?
I think, well, there's an overarching theme here, which is, I think, fixed income today, actively managed, multi-sector, flexible approach, we think is a sweet spot for investors today. You can get a 6 to a 6.5% yield in an actively managed fund. And you compare that to the cash rate at around, 4.25%. It's a decent yield pickup. You don't have to go down in credit quality that much. When we look at this year so far, most of our active bond products are returning between 4 and 5%, compared with cash at around 2%. And so, the other thing we're seeing too with bonds today is that they're starting to diversify a bit more in a portfolio. As inflation has come down, we've seen that correlation reverse. And so when we look at the correlation of treasury rates to stocks or treasury rates to corporate credit spreads, we're actually seeing an improvement in the diversification element of bonds. So we're really advocating people to look at an actively managed approach and really harvest that yield. One other thing I'd say is we're seeing traditional approaches get disrupted by the fact that bond benchmarks and indices have become much more concentrated. With the fiscal issuance out there, we see treasury weights and indices going to 50%. So we think you need to take a different approach.
So actively managed funds, I've spoken to your colleague Rick Reeder about this as well. The weighting of mortgages in the portfolios you guys are running right now. What is it thinking here? Is it consistent with the idea that the long end will stay high and therefore mortgages might still be a place to be headed towards, given you think the long end is coming down? Actually, on our yield curve exposure, we have preferred the kind of 2 to 5 year part of the curve relative to the long end. I do think that you're going to see more term premium as a result of both the fiscal issuance and the more price-sensitive demand base for fixed income today. But we do like mortgages. I think it's one of the few sectors and spread sectors in fixed income where valuations are not in kind of the lower quartile. So you have actually pretty reasonable valuations in mortgages, and we do think interest rate volatility will stay relatively subdued. And so you're getting paid 150 basis point nominal spread in mortgage basis. That's actually a pretty attractive investment opportunity. This all goes down to the big issue here of the short end versus the long end, with a lot of investors feeling like that long end is really what's more material to the economy. How do you see that issue playing out, Stephanie? Do you think that that long end staying higher, now around 4.4% on the 10-year, what does that mean in terms of the ripple effects?
Yeah, so I think we're going to be stuck in this range-bound territory from 4.4 to 4.6 for a lot of the year. So I'd be adding duration to portfolios if we get to 4.6. I think we're going to kind of bounce around for a while. From an economic perspective, of course, it still has been putting some headwinds on the housing market. I think the other thing that has held back housing activity in the first half has not just been rates. I think it's also been the concern around the economic backdrop. If you think a recession is coming, why are you going to buy a house now? You're going to wait for lower prices and lower mortgage rates in the future. I think now once people realize that recession is probably not coming, they're going to start adding back to housing activity, in which case that headwind is kind of going to subside too, in which case the interest rate is a lot less sensitive for the economy than sort of many folks expected.
I've just been being drained from my 6% mortgage, and I'm waiting for that moment of refinance. Stephanie Roth, Chief Economist at Wolfe Research, and David Rogal, Lead Portfolio Manager of BlackRock's Total Return Fund. And up next, the auction block. U.S. high-yield volumes stay red hot. July is topping $27 billion, having its best month since 2021. We're going to talk about credit next. This is Real Yield on Bloomberg. I'm Sonali, Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we saw some hot and cool areas in credit issuance this week, starting with U.S. high grade. Volumes coming in at the low end of forecasts, all around $23 billion. And you saw names like Amex, Pepsi, Bank of America leading the way for sales. You saw a similar cool down in Europe, where it was the slowest week for this year in the primary market. And in U.S. high yield, I told you before the break that this was the hottest July for sales since 2021. CoreWeave helped drive that volume this week. It sold $1.75 billion, which will be used in part to refinance debt. The new debt offering is CoreWeave's first since May. And leverage loans are red hot. Weekly volume of around $85 billion, making it the second busiest week of all time. And you can see in this chart, Monday was the second busiest day on record. Borrowers continue to lower costs by repricing existing loans. Speaking of credit, Alex Patron from Rockefeller Asset Management still sees opportunities.
Think of some of the events that we've seen when spreads are at all-time tights, as they are today, and it very much is technically driven factors, tremendous demand, limited supply. But when you see spreads at all-time tights, you're almost looking for a reason to say, well, spreads should widen out from here. And in those environments, you take a step back and you say, is this a buy opportunity? Candidly.
And now we bring in Leslie Falconio. She's head of taxable fixed income strategy at UBS Global Wealth Management, and Lotfi Karoui. He is chief credit strategist at Goldman Sachs. Leslie, you look at this market right now. How do you feel about the debt that's coming to market, the new supply? Are you comfortable with the additional risk that is being taken on?
Well, I mean, look, there's no question. As the segment showed, there is a technical bid out there. And I think that given the fact that the equity market is making these new highs, the corporate balance sheets are still strong, and there's a lot of catch up, too, from what we saw in the April shutdown, where I think institutional investors were underweight their bogeys. People kind of took a step back in terms of being overly defensive. You know, I'm not surprised the supply is coming out. I'm not surprised there's a bid for the supply. But when we think about where risk assets are right now, at least in our opinion, we're neutral high yield here. We're neutral leverage loans here. And I do think the risk going forward is that as the equity market makes these new highs and as credit spreads are so tight, the correlations have a tendency to rise. So if, in fact, we do get an environment where, say, the Fed doesn't cut or inflation stays higher for longer, then you're going to have a situation where the equity market falls, treasury yields go up, and credit spreads widen. Similar to what we saw in 2022, but not the same magnitude. So while credit spreads are tight, we're not looking for a large amount of widening, but we really do like the better in terms of up in quality here.
Lotfi, let's talk about risk right now. Let's talk about that push-pull between the high-yield bond area and the leverage loan space. What do you like better and why?
Between bonds and loans, I would say I like bonds better than loans. And we've been neutral for the last, call it month to month and a half. But the main reason, and I always viewed this through the lens of that trade-off between carry and duration. But you talked about that in the previous segment. But the path of least resistance seems to be for a steeper curve. It doesn't matter how exactly we get there, whether we get there because the Fed is in a position of strength to deliver normalization cuts, or whether we get there because the Fed is forced to respond to recession risk. The fact is that the curve will, very much likely steepen from here. So you lose a little bit of carry on the leveraged loan side. And then we're comfortable taking duration risk on the bond side. I think there is some kind of a new equilibrium for intermediate long-dated yields. It's a lot more range-bound relative to what we saw last year. So vol has declined, there. It's really a valuation call more than anything else.
Leslie, to speak to what Lotfi was talking about here, that bias towards a steeper curve, in that scenario, who loses?
That's a good question. I mean, we've been calling for a steeper curve since the second half of 2024 after 2 years of inversion. Listen, the steepness of the curve is a consensus trade now, right? It's very much a consensus allocation. Everyone's expecting that term premium to remain high in the back end. You might not see that kind of velocity in terms of the delta and changing in terms of that term premium, but it's going to remain high. I do think that right now, in terms of the steepness of the yield curve, because it is more of that consensus, really the risk is that the curve flattens, right? And I think that flattens if, in fact, we do see this slower growth than what we're expecting in the second half of the year. If a lot of this sort of rhetoric in terms of, tariffs being a headwind to growth actually play out. So the risk is of the curve flattener because the steepener is definitely a consensus allocation right now.
Lotfi, when you look at the leveraged loan world right now, one thing that a lot of investors have been looking out for is that return of M&A, particularly private equity-driven M&A. Now, we know that that's a space that's been very highly levered and has added more debt on top of debt, probably on top of debt again. So as they come to market, are investors going to get comfortable with the deals that are being done?
Well, you're right. I mean, the share of M&A in the primary market is the highest it's been in probably 3 years now. And so there's definitely been a pickup. But if you look at other sources of use of proceeds, other forms, basically companies are deploying the debt, I would say this is still pretty much a market that is centered around refinancing. And so, yes, M&A volumes are up, but in aggregate, it doesn't seem to me that that's sort of causing a deterioration in credit fundamentals. It's not coming with a significant increase in leverage. I would get concerned if we see evidence actually that fundamentals are deteriorating. And so to me, it speaks to improved sentiment in boardrooms. I think there's certainly growing comfort that we've put most of the headwinds on the tariffs front behind us here. And as a result of that, I think you've seen that pickup in M&A, but it's not a source of concern from a fundamental standpoint.
Lotfi, a lot of questions around the call you made around ending your overweight to bank bonds right now. And of course, that matters for the banking system. They're looking for the lowest cost of capital. What's behind that recommendation?
It's not a negative view on fundamentals. It's a view on valuations. You know, we had been overweight the banking system pretty much actually since the aftermath of the regional banking crisis in 2023. That trade has had a great run to the point where big money center banks are actually now trading well inside the IG index. We don't see value. Now, we're cognizant of the fact that there's a tailwind from deregulation, but I think that tailwind will benefit a lot more the equity market than credit markets. It's really about valuation as opposed to any concern over the fundamental outlook.
Guys, we got to leave it there. We're running out of time. Always wish we had more. That is Leslie Falconio with UBS Global Wealth Management and Lotfi Karoui with Goldman Sachs. And if you can't get enough on credit like me, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. And still ahead, the final spread, the week ahead, we get earnings, the Fed decision, and a Trump tariff deadline August 1st coming in hot and heavy. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, President Trump looks to meet with UK Prime Minister Keir Starmer to discuss trade. Plus, Secretary Bessent meets with China. All eyes on that. And Tuesday, U.S. consumer confidence, and also will be at the height of earnings season with names like Barclays, Boeing, Starbucks, and Visa. Wednesday is Fed Day, plus Mag 7 earnings. Just an exhausting middle of the week. Microsoft and Meta after the close that day. And Thursday, more tech earnings. Amazon, Apple, Samsung, plus U.S. PCE and a BOJ rate decision. Friday, August 1st is that Trump tariff deadline. Also Chevron and Exxon earnings. And for my final thought, labor and inflation data next week, because of course you're not going to just watch for the way the Fed is moving into the dot plot. You're going to be watching the PCE, with core PCE expected to come in at 0.3%, with the prior reading being 0.2% month over month. Year over year, it's expected to remain flat at 2.7%. And non-farm payrolls we're watching to come in at 110K. We'll keep an eye on it. But from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.